The gold market has just flashed a red warning signal. The weekend spike, which seemed like the beginning of a tsunami wave, must be viewed honestly. It is a classic bull trap, fabricated by unfounded rumor leaks and thin liquidity. If you are holding a gold long position, buy. Listen closely. This overreaction is putting you at risk of a plunge of at least $30 to $50 immediately when the market reopens. Do not let the fear of missing out, FOMO, turn into fear of losing. Fear. We need a deeper analysis of the leaked information from the Fed and the danger posed by U.S. bond yields. The main story revolves around the upcoming December meeting of the U.S. Federal Reserve, or the Fed. The market's base scenario has been clearly established. The Fed will hold interest rates steady and possibly issue a dovish signal regarding the rate cut path in the first half of next year. This very scenario has propelled gold to its highest level in months. But here is the key point. The recently released November jobs data was much stronger than expected. Specifically, the number of new jobs created and the labor participation rate are both at positive levels, indicating that the U.S. labor market is still too hot. A hot labor market is the number one enemy of the Fed's inflation-reducing policy through interest rate hikes. It provides the Fed with a valid reason to continue pursuing a higher-for-longer policy, higher interest rates lasting longer. And then the rumor surfaced. Over the weekend, unofficial news channels began leaking information about a hawkish group within the Fed's Board of Governors putting pressure, demanding that Chairman Powell delay or weaken the dovish message about rate cuts, citing this strong employment index. Gold reacted instantly. It spiked, but with extremely questionable liquidity, primarily driven by algo trading triggering stop-loss orders of the short side. Sell. The brutal truth is, this spike is not supported by real smart money flow. It is a price squeeze. To analyze this bull trap, we must look beyond the price chart. There are three critical indicators loudly warning of risk: bond yields, US 10Y, dollar strength, DXY, and market liquidity. The relationship between gold and bond yields is inverse, but it is not simply that gold goes up when yields go down. Market logic. Gold is a non-yielding asset. When the real yield, interest rate minus inflation, of U.S. Treasury bonds rises, holding gold becomes less attractive. Conversely, when yields fall, the opportunity cost of holding gold decreases, making gold more appealing. Current analysis, the 10-year Treasury yield, US 10Y, has seen a slight decline recently, providing a foundation for gold's price increase. However, if the Fed, even if only hinting at maintaining higher for longer rates during the December meeting, yields will react strongly. A bounce in the US 10Y will immediately draw capital out of gold and push the DXY higher. A rebound that merely touches 4.5% is enough to trigger a large-scale gold sell-off. The US dollar, DXY, and gold have an inverse relationship. When the US dollar strengthens, gold becomes more expensive for holders of other currencies, leading to selling pressure. Current analysis. The DXY is in a consolidation zone. The November jobs strength is a powerful catalyst for the DXY. If the Fed decides to be more hawkish, investors will rush into the US dollar for short-term safe haven assets, pushing the DXY past critical resistance levels. This is the double-edged sword threatening the gold long side. This is the most direct evidence that this is a trap. Trading reality. The weekend rally occurred when the Asian market was asleep, and major financial centers in the West, London, New York, were seeing reduced trading volumes. The price surge was led by small retail buy orders, accompanied by automated stop-loss hunting algorithms. If a rally is not accompanied by large trading volumes from central banks, hedge funds, and major financial institutions, it is just noise. Consequence. Due to thin liquidity, when large funds decide to take short-term profits or the market realizes the Fed is not reversing based on rumor, there is not enough buying power to absorb the selling pressure, leading to a vertical plunge. This is why investors must be especially wary of price increases not backed by volume on weekends or near major events. Hypothetical scenario. Rumor is misleading. The Fed will still adopt slightly hawkish language compared to the market's dovish expectations regarding the cut path. Scenario 1. Technical correction. Gold has risen too hot. The current price range is a very strong psychological resistance area. A correction to the next support level is absolutely necessary to consolidate the foundation before contemplating further gains. Scenario 2. Gold sell-off. If the Fed emphasizes maintaining current rates until the second quarter of next year, the entire rationale for gold's rise, due to an early Fed rate cut, will collapse. Funds will be forced to liquidate long positions to avoid losses, causing gold's price to freefall. A price drop of $30 to $50 is a conservative forecast. A drop of $70 to $100 is a possibility in a panic sell-off. This is not the time to act with the crowd. The market is trying to deceive you. These are the specific actions you need to take. Short-term, take profit. Take profit on a portion or all of the long positions you opened at lower price levels. Do not try to earn the last dime at this table. Capital preservation is the top priority. Set an extremely tight stop loss. If you decide to keep a portion, set a firm stop loss order immediately below the nearest support level, or about $10 to $15 below the current price. Do not let profit turn into loss. Absolutely do not FOMO. This is the highest risk time. Do not get swept away by false euphoria. Chasing the price at a thin liquidity peak is the action of inexperienced investors. Wait for confirmation. If gold truly wants to rise further, it must break the peak accompanied by massive trading volume and confirmation from a deep drop in bond yields. Be patient and wait for the correction. A safer buying opportunity will appear at lower price levels after the news from the Fed is clearly announced. The market does not care what you think or how you feel. It only cares about data and signals from central banks. Currently, strong employment data and rumors of a Fed pivot are creating an internal contradiction. This is the time to return to the core principle. When there is uncertainty, retreat and protect your capital. The core event this week is the Fed's official statement. Do not trade based on rumors or euphoria. Trade based on data and strict technical analysis. In summary, this is a trap. Retreat, take profit, and wait. A $30 to $50 drop is a warning shot you should not ignore. This bull trap market will turn fear of missing out into genuine regret if you do not act now.